Welcome to Money Chat Today with your hosts Larry Steinhouse and Rick Lee. From the School of Hard Knocks, they present with years of knowledge on how to help you make more money and how to keep it.
Hi, I'm Larry Steinhouse.
And I'm Rick Lee.
Welcome to Money Chat Today. This is a show where we help people make more money and help them keep it. And today we have a special show for you. We have a guest today. We have Ed MacConnell. And I want to tell you a little bit about Ed MacConnell. Ed MacConnell is a health insurance expert. And he was actually introduced into the health insurance business in a very unique way. In 1988, Ed's daughter was born with an incurable liver disease. The liver transplant that she needed to save her life was not covered by Ed's health insurance policy. Ed became a tireless advocate for his daughter and for her life. And in the process, he learned how to deal with health insurance companies. Years later, while running his own cleaning business, Ed decided to change careers and capitalize on his experience with health insurance providers. He became a licensed health and life insurance broker in 1995 and began to work with individuals and companies in regard to health insurance. And because of Ed's experiences, he knew he would serve his clients best by becoming a broker instead of a captive agent. And Ed owns his own brokerage called EMA Benefits. And welcome, Ed. Thanks for coming.
Yeah, we're glad to have you.
Thanks for having me. I'm glad to be here.
So, in your introduction, we talked a little bit about your daughter, and I'd love to hear a little bit more about that story because it's actually pretty heartwarming.
Well, she was born with a disease where she did not have any bile ducts.
Wow.
So, in order to save her life, they had to give her a transplant,
Right.
which was not covered at the time by my insurance company because they said it was experimental. So it took some time. We didn't have an internet to do reference work in 1988 or any of that stuff. I sort of became an expert by accident in the health insurance business in order to have everything paid for because it was a lot of money.
I can imagine.
And she's 22 now.
That's great.
That's fantastic.
She's doing great.
Oh, fabulous.
As they say, Bible tough.
Well, it's tough. Thank you.
So tell us a little bit about insurance and types of insurance that people can have. Maybe the kind of groups.
Well, in this area anyway, you really have three types of health insurance. You can get personal health insurance.
Okay.
That's something that you buy on your own. You can get insurance through a company, like a small group, maybe 2 employees and up. And then there's much larger insurance plans from companies that have, say, 100 employees or more, which are actually usually what we call self-insured plans.
So is there a basic difference between all of them?
Well, there is a big difference. There's
Okay.
a big difference in each of the plans. First of all, for a personal plan, you do need to go usually through a lot of things like medical underwriting. There's some health history check and things like that, and they're not guaranteed to be issued. So in Pennsylvania anyway,
Wow.
you have to go through an approval process before you can buy health insurance for yourself.
So in other words, and most of our audience also are probably individuals with health insurance or small businesses. So, but if they're an individual, they have to apply for the policy.
Right.
They have to then get it underwritten, and can they be declined?
They can be declined.
Wow.
Yeah.
I always thought that you couldn't be declined for health insurance.
No, not in Pennsylvania. Pennsylvania, you can be declined.
Wow.
Yeah.
Well, that's interesting. Huh. So then the next thing, maybe it's a small company, and a small company is considered what?
A small company is a group of 2 employees or more.
Okay.
So with two employees or more, you can be underwritten but not declined.
Oh, that's interesting.
So because they have the ability to spread the risk around, the insurance company will, pool the risk and provide a rate. Now that rate may not be affordable because if you have a non-healthy group, they can charge you basically whatever they want to charge you. But if you decide to pay the plan premiums, they will provide the benefits.
So they basically underwrite it as an individual plan, but they can't decline you.
In a group plan, correct? Yeah.
In a 2-group plan, right?
2 and up.
Okay, cool. And then the next group would be what kind of group?
Well, if you have companies of 100 or more employees, you're usually talking about a self-insured plan. It's not insurance really. What you usually will have is an employer who pays the claims. And
That's interesting.
they will rent a network from an administrator.
Right.
Like in this area, some of the big insurance companies are also administrators.
So basically, if I had a big company with 100 employees or more, I wouldn't have a health insurance policy? Is that what you're saying?
You wouldn't have health insurance. Your company would pay claims of the employees.
Well, what if one of my employees gets really bad cancer and it costs me a few $1,000,000?
Well, it won't cost you a few $1,000,000 because your administrator will also buy stop loss insurance.
Oh,
So
okay.
the stop loss insurance provides coverage after a certain dollar amount. So if you have one incident that costs a certain dollar amount, say $30,000, then the insurance will kick in after that.
So if I'm an employee of one of these big companies, should I worry that it's not going to be claimed, the claim's not going to be paid like a big insurance company?
No, not necessarily.
Really?
For most people who are on those plans, they don't know the difference.
Really?
People have their insurance card and they just assume they have insurance, and it doesn't really matter to them because there's really no impact to the member. The difference is that in a big company like that, the employer has a lot more flexibility to choose what coverage they want to give and what they don't want to give.
That's pretty
So
amazing.
they can pick and choose certain things.
Exactly. Now, at what point does it pay a company to switch from having an insurance policy to being self-insured? Is there a number of employees, generally speaking, where a company would say, "Hey, it's will cost us less to be self-insured"? Are there numbers, or is it each individual case?
It's not necessarily costing less as much as it is predictability. So when you have
I see.
one person who's insured, they can be very healthy for many, many years and not run up a lot of claims. But then when they do if they get very sick, the claims instantly go through the roof. Well, the more people you have in that pool, the less likely you are to have that spike in utilization. So like if you have 10 people and you pool it together, the predictability is better than one.
Okay.
And when you get closer to 100 employees, you have much more predictability, and the further you go up,
All right.
the more predictability you have. Also,
Interesting.
when you have that type of a plan, things like wellness programs can have a greater impact directly to the company's bottom line, because if they have a healthy group, they're paying less claims.
And a wellness program is like a gym membership?
It could be a gym membership, it can be a weight loss program,
Yeah,
quit smoking.
Right.
Yeah.
Cholesterol.
Yeah.
Yep.
And those plans, I heard of what do you call that? A policy that you put your money into, tax free.
Well, health savings.
Okay,
health
health
savings
savings,
account.
right. Sure.
Yeah.
So you would put that money into that, and you can pay tax free dollars into your gym membership, and
you can do that too. But what a health savings account does is it basically you have a high deductible health plan. A plan that doesn't really cover anything until after you satisfy a deductible. A common one is anywhere from $1,500 to $3,000.
Okay.
So the way we look at that is self-insurance, and then the medical plan will kick in at a high level, 90 to 100% after you've satisfied the deductible. Because you have that deductible though now, and that qualified plan, you can put money aside that can be funded by the employer or the person, tax-free. So you draw off that money from your health savings account, which is actually a bank account, to pay for your claims.
So if I understand you correctly, I could take a health insurance policy, I can buy health insurance policy, let's say I have a group policy, I can buy a group policy, I can open up a health insurance account, health savings account, right?
Yep.
And I can use that for my deductible so I can save money. So basically the health savings account becomes part of the insurance. Would that be a good way to
It's kind of like a connected component.
Okay.
It's not part of the health insurance, but it's where you're funding your self-insurance portion. So you've said, if you've saved, as an example, if you have a $3,000 deductible, but you saved at least $3,000 for the year,
right,
or more, you put that $3,000 into your savings account, tax-free. During the year, when you go to the doctor or get a prescription filled, you'll take the money out of your savings to pay for those claims. So if you do not use it all during the year, then that money rolls over to next year.
That's amazing. So how much can somebody really save when they do this?
Well, they can save a good amount. When I did my own, when I switched to the HSA plan, I went to a $3,000 deductible, but my premium savings was almost $4,000.
Oh, okay.
So even though I knew I wasn't using the plan a whole lot, if I did, and I ran up a lot of claims, I would stop paying at $3,000. So saving $4,000, I was still ahead by $1,000.
Right, gotcha. So how does somebody set up a health savings account?
A health savings account has to be set up in a certain way. First, you have to have a high deductible health plan that's qualified.
All right.
It has to meet certain requirements before you can have the savings account. Most of the insurance companies will work with their own bank. They'll partner with the bank so that they can say to the bank, yes, this person has a qualified account, now they can have the savings account. So, or you can go to your own bank and do it if they do health savings account.
So I'd imagine there's certain IRS filings for this too that people need to be aware of.
Yeah, you have to file it on your tax return.
Oh, okay, cool, excellent.
Yeah.
Right, now are there limits to what you can contribute to the HSA? Let's say you have a $3,000 deductible on your health insurance.
Right.
Are you limited to putting $3,000 a year in your, are you limited to the amount of the deductible that you can put into the HSA, or can you put more in?
Well, the amount that you put into your account is not linked to your deductible.
Okay.
But there is an annual contribution limit.
Right.
And there's no maximum balance though.
Okay, no maximum balance, but there's an annual contribution limit.
Yeah, it's about $3,000 for a single employee.
Right, now is that based on your income, or how do they
No, it's not based on your income. That's an amount that's set by the IRS at the beginning of every year.
Oh, so they say per employee.
They say a person.
There's
So,
a set limit.
yeah,
Right.
and it doesn't matter if it's a group plan through a company or your own plan, but they say you can put in $3,000 or $3,050 for this year, this plan year,
Okay,
2011.
Right.
Now, if you're over 55, you can actually add an additional $1,000 to that as a catch-up contribution.
Can you give us actually maybe a real life example of this that happened?
Just so happens that I have a real life example right here. So,
Really?
coincidentally. So this here is a small company that I have, who's a 2-employee company. They have 2 families.
Okay.
Just to give you an idea, now when they did this, they did not switch insurance companies. They were able to keep the plan they had. They were able to keep the style of plan they had. So they had a PPO, where they didn't have to get referrals.
The PPO is?
PPO is a preferred provider organization.
PPO, okay, gotcha, great.
So that means that they don't have to pick a primary doctor.
Okay.
They don't have to get referrals. Some people prefer to have it like that, but it usually costs more.
Mm-hmm.
They went from a PPO-A to PPO-B.
All right.
The premium for last year, 2010, was $47,900 for the year.
Wait a minute, how many people were in this group?
2.
How much was the premium?
$47,972.
Most of our small business owners don't even make $47,000 yet.
Yeah, I didn't either.
It's amazing
That's
that
a
much.
lot.
Holy
That is-
cow!
Well, this is a professional, and
Okay.
they have what they consider a very rich plan.
All right.
So they have low co-pays out of pocket, $5 to see a family doctor, $15 to see a specialist, a $75 copay if they went into the hospital for each day they were there.
I see.
So they switched to this HSA plan, which had a $6,000 deductible for each family. But then the plan covers their medical 100% after the deductible is satisfied.
Wait a minute, so if I got this right, they put $6,000 into the HSA, and the HSA pays their entire deductible, so they actually have no deductible now.
Correct.
Wow, that's pretty cool.
Yeah. So the employees were paying $5 before at the doctor.
Huh.
Are not paying anything now because the company said, here's your $6,000, and then they deduct it from their savings account when they go to the doctor.
Wow. So, and I imagine it was a savings. What was the savings?
Yeah, well, they had to cover the deductible, which was $12,000 between
Right.
the 2 employees, but still, they saved about $21,000 after the deductible was satisfied.
After they put the money in the HSA, they saved $21,000.
Right, yeah.
Wow, that's amazing.
Incredible.
Yeah.
I bet you they got you a nice Christmas present, huh?
Absolutely not.
So in essence, the insurance companies are really willing to discount the premiums if they can raise the deductibles.
Yeah, and it makes sense when you think about it, because when you have a deductible of that size, you're less likely to abuse the plan.
Right.
And they benefit from the compounding of all the employees. So where one employee sees a $6,000 deductible, Blue Cross sees here 12, and if they had 10 employees, it'd be 60. So when you think about it, they can really add it up over and over and over again.
Right. Could you help our audience a little bit? I think they might have questions about a PPO versus having a primary care physician. I know there are different types of plans. Would you just explain a little bit more the difference from their perspective?
Well, for a common type of plan is an HMO.
Right.
When you have an HMO plan, it means you're going to pick a primary care doctor when you sign up. So when you sign up for the plan, you select, I'm going to pick Dr. Barnaby Jones. He's my doctor. I'm going to go see him for everything.
Right.
And the HMO plan forces you to do that. Lots of people don't mind doing that because that's what they do anyway.
Sure.
Okay?
Right.
So, but when you pick your primary doctor, what you're also usually doing is picking your panel of specialists. A lot of people don't realize that even though your HMO may have a very big network of specialists, when you pick your primary doctor, you've picked your panel of specialists too.
So basically, if my doctor's now associated, let's say, to the podiatrist or the urologist or
right. He cannot usually give you a referral to see that specialist. He has to give you a referral to see the specialist that he's capitated to or contracted with.
Okay, I got you.
So
that's interesting.
when you pick Dr. Barnaby Jones, you've also picked his podiatrist, his chiropractor, his cardiologist. Sure, yeah, you really have done that. Of course, there's exceptions. Some plans have the exceptions built right in it, but that's a typical HMO. In a PPO, you have the complete opposite of that restriction. You have the freedom to choose any doctor you want.
That's great.
You can go in the network of participating providers, you can go outside the network of participating providers, but you don't have to tell anybody up front, I'm going to pick Barnaby Jones.
So is an HMO without a referral similar to a PPO, or is it really not that big of a deal?
An HMO with a referral is what we actually call a PPO lookalike.
Okay.
So because we say it looks a lot like a PPO. The real difference is in how the doctors are compensated. But for most people who are on an HMO without a referral, they don't worry about it so much.
Okay, good, excellent, wow.
Right now in the PPO, if you go out of network, that does cost you more?
Yes, an arm and a leg.
Not just an arm and a leg.
So yeah, you really, depending on the type of plan you selected, it's nice. It's kind of like a safety valve that if you want to see a provider who doesn't take the plan, you will have some coverage. But you really do want to try to stay in the network of participating providers.
Right.
So I have to bring up the subject.
Yep.
Healthcare reform.
Yep.
And we all know that there were sweeping changes. You may like it, you may not like it. Doesn't matter. But maybe we can get a little bit of insight about what's going to happen. Maybe you can tell us a little bit. Maybe even summarize just a little bit about what has happened or what will be happening.
Well, so far, only a few parts of the reform have kicked in.
Okay.
And most of the major changes are scheduled to take effect in 2014.
Okay.
And then the last part is supposed to happen by 2018, so everybody's heard about the Cadillac tax.
Okay.
So, but what's happened so far is they really have just made changes to the types of plans that people can have. So what they've said is, you health insurance companies have to provide these benefits.
All right.
All right. So what they did is, number one, they said we want preventative care covered 100%. Because even if you have a big deductible, we don't want people to say, I don't want to spend $50 to go to the doctor. I want to go and get my annual checkups. Because if they have preventative care, maybe you catch stuff early.
So preventative care would be annual checkups, blood work, blood pressure monitoring.
Right.
Well,
for most people, it's your annual checkup and blood work. For women, it's a gynecological visit, and a pap smear and a mammogram.
Okay, yeah.
And kids actually are usually included, and immunizations too.
And I also understand that they changed the dependent age too, and what does that change to?
Previously, if your kids were over 19, in order to keep them covered, you usually had to be in school.
Okay.
They had to be full-time students. But now, as long as they don't have a job that provides health benefits, they can be covered up to age 26.
26?
Yeah.
Wow.
Yeah, good luck kicking them out.
I wonder, if that may be good, it may not be good. I guess it's great if you have a family and you're on a family plan and you're paying for the family plan, all of a sudden you get your 25 or 26-year-old covered. I think that's a great thing. It does have a benefit, sure.
Well, in some states like Pennsylvania and New Jersey actually have extended benefits after that. You can go to age 29 or 30.
Wow, how do you qualify for that?
You pay for it. It's not free.
So no, is everybody automatically qualified for that thing?
No.
Okay.
There's certain requirements you have to. Previously we'd have children from age 23 up to 30 on those extended benefits, and now they're right back on their parents' plans up to age 26.
So I know one of the biggest things was the pre-existing condition clause. What is the truth on this?
Well, pre-existing conditions really more applies to the personal insurance that we were talking about before.
Individuals will go to buy their own.
Right. If you're buying a personal insurance plan now, pre-existing conditions still apply. In most places, in Pennsylvania, they still do. Except for children under age 19. So the law said if you have a child and you want to buy personal health insurance, the insurance company can no longer use their pre-existing conditions as a way of not extending them coverage.
So I'm not sure. So has that kicked in now? So if somebody has a pre-existing condition can buy insurance to that?
They can buy insurance for their children as long as they're buying it with themselves.
Okay, but what about their own pre-existing condition? I'm a 25-year-old single male. Well, I wish. Anyway. and I buy insurance and I have, I don't know, some weird disease or I don't know, maybe I had cancer 2 years ago.
The insurance company is going to have an opportunity to look into your health history. They're going to ask you questions, and they can decide whether they want to offer you insurance, whether they can offer it to you at the price that they quoted you, or whether they want to exclude or limit payments for that pre-existing condition that you already have.
And that's with the healthcare reform, or?
Right. Now, if you're trying to cover yourself and your children, then your children would be part of your plan. They could not use their pre-existing conditions against them.
So the whole pre-existing condition thing is still a mess?
Well, yeah, well, Pennsylvania is still here.
Okay.
In some states like New Jersey and New York, there's no pre-existing conditions anyway.
Right. So there's a lot of, seems like there's a lot of state regulation of health insurance as well as federal government.
Yeah, well, up until now, everything's really was done at the state level. So now this is when the federal government is stepping in and saying, we want you to have this, we want you to have that, we want you to have that.
Right. So then certain states already prevented the insurance companies from excluding pre-existing conditions.
Yep, and those states usually the insurance costs more.
Right. Okay.
So, I didn't know here about the tax or a penalty or something with insurance, not having insurance. How is that going to work?
Well, there's an individual mandate that's built into the law that's set to take effect in 2014. That's one of the major sources of debates, as we've heard the lawsuits and everything else, because a lot of people feel that the government should not tell anyone to buy anything.
Right.
Okay.
Some say it's unconstitutional. Some say, I understand.
I'm not going to debate the pros or cons of that.
Right.
But there is some sense in that, in the sense that it's hard to tell the insurance company they have to cover everybody, and they have to take everybody regardless of their health issues, and then allow people to not enroll, because the whole purpose of insurance is to buy something in case you need it.
Right.
You don't usually buy car insurance to drive your car into a wall. You don't usually buy homeowners insurance so you can burn your house down. But people do buy health insurance because they know they have to go to the doctor. Well, if you knew that you didn't have to buy it until you were sick, most people would not buy it ahead of time. Because you could wait right up until the point where you got sick and then go and buy it, and then you'd have the coverage.
So I could go to the doctor because I have a pain, find out it's cancer,
right,
and then say, hey, Ed, do me a favor, sell me a health insurance policy, and you can't even, and you don't care that I have cancer, you just have to sell it to me.
Right.
So all this time I had no coverage, and all of a sudden when I get sick I have coverage. Wow, that's that could be rough for insurance companies.
Well, it flies in the face of the whole purpose, the whole principle of insurance, is that the many pay in so that the few can use it when they need it.
So now, what happens to the person who doesn't have health insurance? He pays a penalty, correct?
Under the new law, if it goes through the way it's supposed to, they'll pay a small penalty the first year, and that should increase every year after that.
And I should say, while we're filming this, they're actually in court now, right? Aren't they?
Yes.
So so by the time you watch this, it's changing again. Just so you know. So how is it going to affect the individual now? I know the concept is to try to get people who are having difficulty buying insurance to be able to buy insurance. How are they going to be able to buy insurance now?
Well, once the mandate kicks in 2014, it coincides with the creation of the state-based exchange system. So the whole idea behind the state-based exchange is that now everybody has guaranteed to issue coverage. Regardless of their previous health or their previous coverage, they can walk into the exchange and buy an insurance plan.
Okay, so it's basically like a store where you have all the shelves of insurance.
Correct.
Like the one commercial that went.
Right.
The car insurance commercial.
Right. Yeah, it's very similar. Right. So what will happen is, right now it's difficult for an employer to tell their employees, especially here in this state, I'm not going to buy you health insurance. Go get your own. Some employers have tried to do that, and then they'll say, I'll provide you with a flat dollar amount to go buy health insurance. The challenge with that is that if you hire an employee and you tell them you're going to give them coverage, what do you do when they can't get covered? So the exchange eliminates that.
Okay.
So then, if the employer offers the health insurance or not, you can walk into the exchange and you can buy a health insurance plan. That's really the concept.
So if I get this straight, if my company has, says XYZ Insurance Company now, 2014 they'll have A through Z, A, B, C, D, all different insurance policies, and I can go, I want that one, or I want that one, or I want that one. regardless of what my employer decides
Right.
To cover me with.
Well, depending on the size of the employer.
Okay.
So a company with under 50 employees, there's no mandate to provide health insurance. So it'll really be up to the employer to choose whether they want to offer health insurance or not, just like it is.
I'm sorry, under 50 employees?
Under 50
Okay.
employees. If you have over 50 employees, you'll be required to pay a penalty for each employee.
All right.
Okay, so that penalty right now sits at $2,000
Per
year
employee, okay.
per employee, right? So what will happen is these taxes are there to help fund the subsidies that will be available through the exchange. So you'll have you're less likely to have an insurance plan through the company. You're more likely to have your own, and your employer may also provide some funds to go and get it. The difference between now and then is that right now, at least here in Pennsylvania, you can't just go. Not everybody can go and get it.
So basically, I would say, okay, I go to exchanges, I want to buy ABC insurance policy, and my employer wants to contribute, and they say they're going to contribute $200 towards it.
Mm-hmm.
The premium might be $600. I pay the difference.
You pay the difference, and you might also qualify for a subsidy that'll help pay some towards it too.
How does the subsidy work?
Mm-hmm. Well, the subsidy will be based on your income.
Okay.
So you may go to the exchange. I mean, looking at it as a store is a good analogy. So you walk into the store, and instead of shopping first, they say, okay, look, give us your income, give us your information, everything else. And they'll say, all right, you qualify for a subsidy, you get so many dollars per month. So now, if you know you're getting $200 a month,
right,
and you know your employer is also giving you $200 a month, you have $400 to work with.
Okay.
So now you can go to the aisle that has the $200 policies and keep the $200 from your employer.
Really?
Or use it for something else.
Okay.
Right?
Is that tax free?
Yeah. It'll be tax free, yeah, and maybe you buy dental plan.
Sure.
Maybe you get something else. You might go to the $300 policy aisle, you might go to the $400 policy aisle and use up all the money you're getting, but you know you've got that kind of a plan. It'll be up to you to choose basically which type of policy, and you'll know that you're getting money from the government to help pay for it, and you may get it from your employer also.
Okay, interesting. You know, is there anything else that we should know that's important about the healthcare reform?
That it's still, everything's still up in the air.
Mm.
You know,
Okay.
the dependent to age 26 was an important change. The preventative care was an important change. Those are good things that are added into the plan. They don't always have a direct impact on the premium, but they will have an impact on the premium.
Fantastic. Is there anything else we should know about health insurance at all?
Anything else that you should know?
Yes.
Well, that's a generic question. Isn't it?
Anything else you want to share with us?
Well, I mean, if there's something that you want to know, I mean, you know, they did make a lot of different changes. One of the things changed too was that small businesses now have some tax credits available too. To help
that's
cover
interesting.
health insurance too. So,
Can you tell us about that, or
well,
is there details? Or?
it differs for different companies.
Okay.
You know, but generally, most companies that are paying at least half of the premium for the employees can get a tax credit. So for 2010, it was a 35%. Was the maximum tax credit.
So obviously, and you know, I know this is self-serving to you, but they should obviously have a really good health insurance person to discuss these with. And I also would imagine an accountant.
Yeah, if you think that if you're paying for that health insurance for the employees, then you should talk to your accountant about the tax credit, because that was available in actually 2010.
Excellent.
So now is the time of the year everybody's doing their 2010 returns.
All right.
It's a good time to be talking to your accountant about
There's
it.
a difference. There's a big difference between a tax credit and a deduction.
Yeah, really.
Yeah, and I'm not a tax expert.
No, we're not either.
When I asked a number of accountants the difference, they all said that the tax credit is actually better than the
Oh yeah,
deduction.
Right.
Yeah.
Yeah, in my understanding of tax credit, it's dollar for dollar, where a deduction is, you know, your tax base, let's say you're in the 40% bracket,
Right, just
you only get
lowers your
40% of
taxable
every dollar.
income, right.
Right, exactly. That's my understanding.
It's a foreign language to me.
Understood.
Yeah.
Okay, you got your specialty, and that's
Yeah.
good.
Yeah.
Very
So, Medicare.
Oh, sure.
So a lot of Medicare Advantage beneficiaries have some benefits because of the new healthcare law too.
Really? That I didn't know. Oh,
Yeah.
sure. Yeah.
Well, probably the one that has the most impact is the people who have Medicare Advantage drug, the Part D drug.
Okay.
You know, previously there was.
You know what, can you real quick, you know, and some of our audience knows some of this, can you just go through the really quick the parts of Medicare and you know, what the A, B, C, and
Sure, yeah. Well, you have Medicare Part A is what you get when you become eligible, which
Right.
you know, most people don't pay anything for Medicare Part A.
Okay.
It covers hospitalization, but it has some enormous gaps in the coverage, in deductibles. Part B also comes from the government. You pay for that, and that covers some outpatient services like doctor visits and lab tests and things like that.
And I have a quick question for you. If I have A and B, is that similar to having a modern day insurance policy?
No. Mm-mm.
Oh, okay.
No, because there's big gaps in the coverage.
Really?
You know,
Okay.
and except for very few exceptions, there's no drug coverage
Hmm.
with Medicare Part A and B. So most beneficiaries will either buy a supplement or an Advantage plan on top of that.
And the Advantage plan comes